you have a car payment of approximately $400 per month, that reduces your overall ability to purchase a property by $100,000. I'm Kimberly Coots, also known as the Mortgage Maven. I have been doing mortgages for over 10 years now, and we're here to talk about mortgages and how we can help people obtain the financing that they need for their homes.
Kimberly, what does a lender even do?
So myself as a mortgage broker, I am all about processes. I like to do a thorough financial analysis with their down payment, what income they earn, their credit score, as well as any liabilities.
What doesn't a lender do?
Well, that's a tough question. That's a tough question. One of the things that a lender does not do is provide the value of your property. So we bring in appraisal companies for that, or we do automated valuations, but they will be the ones to say your home is worth X amount of money. And then from there, that is how we determine how much of a down payment is required and how much mortgage the lender will provide, but they don't do the appraising of the property.
So Kimberly, what we're going to do now is something a little bit different. We have outlined some real world examples of people who are trying to get a mortgage, and we would love to get your input into what they should do. So the first one, can you pull down number 1 and let's have a look.
There we go.
Okay, the Burnaby newlyweds.
I think that there's an opportunity here. I think that with both of their great incomes, they do have fantastic savings. They are able to secure a mortgage for the type of property they want, which is the 2-bedroom in Brentwood. We don't know if the $95,000 is split between the both of them or if only one of them has it, but say one person only has the $95,000, then we would utilize the max RRSPs that we could take out, which is $60,000. We would use that as the minimum down payment, which means that they would be getting an insured mortgage, and then we would use the TFSAs for any potential closing costs. If we had actually access to the $95,000 and it was split between both of them, then we could perhaps increase their down payment if they wanted, just to bring down the mortgage payment, but it's not necessary. And as for their car payment, it's quite small actually, so $12,000 doesn't really affect their mortgage affordability, so they could keep things as is. The Surrey single dad trades income and side job. So in this particular scenario, his income is not bad, it's pretty good. And so what we would do is, depending on his side income, we would want to ensure that he's had at least 2 years of experience of that side income, because that way we can utilize the 2 years income in addition to his regular full-time job. In terms of the car payment, that is also a very small liability. So we could keep things as is, and that would be totally fine. In terms of the $600 childcare expenses, it doesn't say if that is child support. I'm assuming that it is not child support or spousal support, and so lenders don't actually look at childcare expenses. However, if it was child support or spousal support, then that is considered a liability, and we would need to take that into account. Because they would be putting down more than 20%, or the expectation is that they're going to be putting more than 20%, we could look at a lender who provides a little bit more generous qualifying stress tests. And so if we are putting more than 20%, we can be a little bit more generous. So I do think that he could still afford that Fleetwood townhome based on his file. The North Shore outdoor couple, tech and freelance mix. This is another great scenario. This probably happens all the time. So with vested stock, we can actually take that as income. And so if it's vested stock, it's on your T4s, we can utilize that difference as income for the file. If it is unvested stock, then we can't take that into account. If it is dividend, like say they're incorporated and they pay themselves dividends, we are unable to bump up that income because they've already written everything off on their corporate side of things. In terms of the freelance videographer, it's dependent on their income. Are they a sole proprietor or are they incorporated? So depending on their situation, it will depend on what kind of paperwork that we're going to need from them. But it's up to, if they want to just live off and qualify with the stable job, then anything that videographer earns is going to be gravy. However, if they want to use and maximize the income, then we are going to need to have at least 2 years of tax returns. And depending on the situation, if they're sole proprietor, we can utilize their net income, and most lenders will allow us to bump up that income typically by about 15%. Number 4, the Vancouver newcomer, nurse, strong income, and limited history. With the credit history, just as long as we have at least 18 months of credit history, that should be good. If they were totally new, then perhaps 12 months bank statements would actually assist in obtaining an insured mortgage. And because current purchase properties are a little bit lower than $500,000, she could potentially make a purchase in the Fairview area. She would be utilizing a minimum of 5% down payment with the remaining savings to be used for her closing costs. Last one, the Langley multi-generational family, dual income plus debt and family support. So the first recommendation is to actually pay out the debts with some of their savings. Most lenders will utilize 3% of the balance as a monthly payment. And so with those two debts, they're quite significant. It is a very large liability that would impact their affordability. In terms of the gifted income, they are definitely able to utilize gifted income. And what the lender just wants to see is that the gifted down payment is going to get deposited into the client's bank account. They will have to sign a templated gift letter, which is going to come from the lender that we end up partnering them with. And because they are looking at a property that does have a basement suite, each lender does allocate for rental income differently. And so my rule is to figure out, based on their income, their down payment, which lender actually we're able to maximize that rental income with. And so that way we can, increase the purchase price based on those different policies. That's all that we have time for, but thank you so much. And if you're looking to see what your options are and need some help with mortgage financing, please reach out at kimberlycoots.com.